So last week, I ended up at a fancy steakhouse attending a free dinner investment seminar. Frankly, something I thought I would never attend. And what I want to do in this video is share with you that experience. It was very enlightening to me. It really showed just how dangerous these kind of events can be for unsuspecting individuals, particularly if they don't have some background in the markets and investing, and how these sorts of seminars could lead you to make some pretty serious mistakes with your investments and your retirement plan. So let's start by how in the world did I get here? This is not the kind of thing I would normally attend. My wife and I regularly get postcards in the mail inviting us to various fancy restaurants for some sort of investment or retirement planning seminar. We just throw them in the trash. That's not how I got this one, though. I actually got an email from one of our brokers, a very well-known, broker that you've all heard of, inviting me to what I thought was an educational talk at the broker's offices. It came from my representative there at the broker, so I quickly responded, and I thought, yeah, I'd like to attend this. What was it about? Well, it was about dealing with volatility in the market, and I thought that's a good topic. I'd like to hear their views on how to do that. In fact, let me read to you what the email said. It said, with a disciplined approach, you can learn to manage volatility for your benefit while helping you minimize risks. That sounds great. Join us for a discussion on how to respond to short-term volatility or longer market downturns so that you can be prepared for anything. And so I accepted. I hadn't read the fine details until shortly before I had to leave for the event, and I realized it's at a steakhouse, not at the broker's offices, and immediately I knew that I had found my way into one of these free dinner seminars, but I decided to go anyway. When I got there, I asked for the event. I said, I'm here with such and such a broker. They're having an event tonight, and they checked their records, and they said, we don't have any such event with that name. And so I thought maybe, I don't know, did I get the day wrong? Well, with a little more investigation, it turned out that the broker had invited me, and my rep was there that night, but they weren't the ones actually putting on the free dinner. It was an asset management firm that the broker refers some of its clients to. So at that point, I knew, okay, this is absolutely one of those free dinner seminars that I've tried to avoid for decades. And so, well, this might be educational, and maybe the meal will be pretty good. So I stuck around and I attended it. Now, once it got started, there were immediately two red flags. There are many more that I'm going to share with you specific to volatility, but there were two that the presenter started with that at least caught my attention. I don't know how others that were there that evening felt about it. What were they? Well, the first was the presenter spent 30 minutes. It's a long time in a roughly 2-hour presentation, trying to convince us that he and his firm can predict where the S&P 500 will be at the end of the year. He went back a couple of years in time. He said this was what our firm's prediction was, where the S&P 500 would end the year, and here's where it ended up. Now, it was kind of funny to me because their predictions were terrible. They were off by 5-10%, not even close in my view. But the way they made it sound good was they listed other firms' predictions. And I don't know how they chose which firm's predictions to use, because there are countless firms that have forecasts. I suspect they picked those firms that would make their forecast look a little better. It still didn't make their forecast look good, but if you had a long list and maybe they were at the top or maybe number 2, I guess it made their predictions look a little better. But it reminded me of a quote from Warren Buffett, and I'm paraphrasing, but it said, forecasts tell you a lot about the forecaster. They tell you nothing about the future. And I don't know if this bolstered the credibility of this firm in the eyes of the other folks attending that night, but I can tell you it destroyed any credibility they had with me immediately. And I think this goes far beyond just some free dinner seminar. If you're interacting with any financial advisor and they're doing anything to suggest they can predict the future of the stock market, or that they use that in their strategy for investing, that should be a big, big red flag that that's someone not to do business with. The second one, in some ways, was even more alarming. He made the claim, it was offhanded. I wonder if maybe some folks listening, it just went right by them. But he made the claim that when it comes to mutual funds and ETFs, active funds that actively try to pick winners and losers in the stocks versus index funds, it's about a 50-50 crapshoot. That, about 50% of the time actively managed funds outperform and 50% of the time index funds outperform. And I knew that that's just incorrect. In fact, let me just show you. This is a report by S&P Global. It looks at the performance of index funds as compared to actively managed funds. That's what this means. SPI, I is index versus actively managed. And here in the United States over the last 15 years, 89.5% of funds under actively managed funds underperform the S&P 500. And you can pick other years, it's still going to be bad. We can also pick other countries. We can look at Europe, for example. Over the last 10 years, fewer than 8% of actively managed funds have outperformed. It really doesn't matter what region you pick. You're going to see similar statistics. Let's look at Australia. Yeah, it's just not very good. And so this was all a concern for me really for two reasons. One was just, you could see immediately this push away from low-cost investments, but also just factually it was wrong. Now, I don't know if he really believed what he was saying. Maybe he did, but I knew that it was factually incorrect. So the evening did not get off on the right foot as far as I was concerned, and it only got worse. So what happened? There is a certain strategy that he used throughout the night. I'm going to give you specific examples, but let me just share with you the overall strategy. The first was to create some sort of fear, usually around volatility. And I'll give you some specific examples, but he would create some fear, some concern, often around volatility. And then he would propose solutions that always had two characteristics. One, they were complex, and two, they were expensive. And we're going to see this time and time again. Of course, his firm is willing to sell you those complex, expensive investments, but anytime you're presented with a complex, expensive investment, it should raise a significant red flag. So, what are the specifics we're talking about? Well, the first fear was of the Magnificent Seven. He pointed out, and this is factually true, that if you look at the top, I think he focused on 7. We could look at the top 10 companies in the S&P 500. They represent a third or more of the entire index. It's very heavily weighted towards those companies. Now, that's not always the case, and it ebbs and flows over time. Let me show you a chart. Here we go. And I'll leave links to everything I'm showing you below the video. This is the concentration of the S&P 500 top 10 stocks. And you can see they've even got an exclamation point for you here. But they put it at 39% of the S&P is in the top 10 stocks, meaning if you invested $100 in an S&P 500 index fund, about $39 of that would be in just 10 stocks. And as you can see over time, it goes up, it goes down. It's been much lower, although at any point in time, it's pretty significant. You can see this is 20% down at the bottom, and it seems to go up and down, up and above and below that mark for the most part. And then as you can see, there are periods of time, including the current one, where it's significantly higher. That's very, very common. Now, there are a couple of takeaways here. His takeaway was, of course, you should avoid index funds because they create these problems for you. In fact, he promoted picking individual stocks, which his firm would no doubt be willing to do for you. And I looked up their asset under management fee with the SEC, and it goes as high as 2.5%. So for a very, very expensive account, they're willing to pick individual stocks for you. What he didn't suggest, though, are other ways to deal with that concentration if it's a concern for you. Remember, the concentration has always been there. It's higher now than it's been at other times, but it's pretty significant most of the time. And yet we can still look back in time and see just how well the S&P 500 has done. But if that's a concern to you, there are low-cost ways to deal with it, right? You could include a small cap or mid cap index fund in your portfolio. Very inexpensive, and it's going to diversify you away from those top 10 stocks in the S&P 500. You could include an international index fund, really diversify away from that concentration in the top 10 stocks. Maybe you add a REIT index fund that invests in real estate. So there are plenty of ways to deal with that concentration issue if it's a concern for you. And I would say just generally, I would never want to put all of my equity exposure in just the S&P 500. So I have diversity beyond that anyway. So the fact that the S&P 500 is concentrated at some level in the top 10 stocks is really not a concern for me at any point in time, even when it's elevated like it is now. But of course, he didn't share any of those strategies with you. He was just focused on the issue of that concentration and then moving folks into complex, expensive investment alternatives. That's the first thing he did. The second fear, he looked at bonds, and he specifically pointed out 2022. In 2022, as we know, both stocks and bonds were down double digits. Recall that interest rates and yields were near zero before that, and they started to rise. Inflation was quite high. Interest rates rose significantly. And when those interest rates rise, the value of existing bonds go down. And he really hit this point hard. In fact, he mentioned long-term bonds. Let me show you this. He didn't mention this specific fund, but this is the Vanguard Long-Term Bond Index, VBLAX. And look at the loss in 2022, 27.22%. That's a bond fund. And it lost almost 30% in 1 year. And he really used that to sort of stoke fears, not only about bonds, but also bond funds, right? Now, there are a couple of things he didn't say. For example, he didn't point out that 2022 was a once-in-a-century event. You can't go back in time and find where stocks and bonds were down double digits like that. It's a once-in-a-century event, and in order for it to happen, interest rates need to be near zero. That's part of what caused those big losses in 2022. It wasn't just that rates went up 4, 5, 6%. It's that they started at near zero when they increased by that amount. The second thing is he didn't focus on short-term bonds or even intermediate-term bonds because the losses weren't nearly as great. He went right to the long-term bonds where losses were significant. Interestingly, his solution to that was an individual bond portfolio. Now, he didn't mention that by the way, a 30-year individual bond lost just as much as a bond fund did. And there's nothing wrong necessarily with buying individual bonds, perhaps. But he didn't cover all of those issues. He didn't cover the pros and cons. He focused on an investment, long-term bonds, that would, I think, create the biggest fear in his audience, and then looked at complex solutions and, of course, expensive solutions to that type of fear. So that was the second one. All right. Then he specifically got to volatility, and he spent most of his time on two potential solutions. And the first was, and I chuckled, I don't know if you noticed, I chuckled when he said this, tax loss harvesting. That's when you have a loss and you sell it sort of to lock in that loss, but then you can deduct that loss against other gains and up to $3,000 of ordinary income. He was specifically talking about direct indexing, where instead of investing in an S&P 500 fund, you would hire someone like his firm, invest in the individual companies that make up the S&P 500, and then when some of those are at losses, they can be sold so you can lock in that loss. So for example, maybe Pepsi has gone down and it gets sold and they buy Coke instead to avoid a wash sale. And you can then deduct any gains with those losses that you got. And that's the idea behind it. Now, I'm not quite sure why he viewed direct indexing and tax loss harvesting as a way to deal with volatility, because it's going to have the same volatility as a fund. I suppose it will allow you to get some tax benefits, but there were a couple of things he didn't mention. Number one, and I'm just going to show you a paper. Here we go, maybe. There it is. I'll link to this. This is just one of many papers. The key takeaway for me is this, and it talks about it in this paper, is that when you start direct indexing to take care of, to try to generate tax losses, the benefit of that quickly runs out, because over time, as most stocks go up, as they do, you'll eventually get to a point where there aren't many tax loss harvesting opportunities. And so you might get some tax losses in the first few years, maybe up to roughly 5 years, maybe. But unless you're continuing to contribute significant amounts of money to this fund year after year after year, which most people aren't, the benefits of tax loss harvesting are going to sort of run out after a few years. Of course, he didn't mention any of this. He also didn't mention that what are you going to be left with? You're going to be left with an account with hundreds, in some cases well over 500 positions. What a mess. There's an expense to have them continue to manage it. So you find yourself with a complete mess of a portfolio. It's generating few tax loss harvesting opportunities for you. And unless you want to take over managing this mess on your own, you're stuck using this firm, paying high fees to manage this complexity. Of course, he didn't get into any of that. And yeah, I don't know what other people thought, but I thought it was a silly way to think about volatility, and frankly, an approach to investing and even approach to tax loss harvesting that I think benefits nobody but the firm raking in the fees. All right, the second approach was it's insane. I think that's a fair assessment of this second approach. He suggested a complex options strategy. What he suggested was you could do what are called puts. That's when you sell to someone else the option. And what's that option you're giving this other investor? You're saying to that other investor, hey, I'm selling you a put on, let's say, the S&P 500 shares. It could be a Vanguard fund or a different S&P 500 index fund. Let's say it's trading at $100, and you sell a put. You sell to some other investor the right to force you to buy shares of that index fund for, let's say, $90. And at first you think, well, that's not a bad idea. I mean, they're trading at 100. Why wouldn't I buy them at 90? If that clown on the other side of this trade wants to sell me shares that are trading for 100 for just $90, I'll do that. And you're telling me I get a fee? He's going to actually pay me for that option? Thank you, I'll take it. Well, that's what they were proposing. They were proposing that you leverage it, that you're going to do this on margin. And the idea is you'll collect that fee and it will be a little extra income for you. And the odds of, in this case, the S&P 500 index actually falling below $90, and these options only lasted a month, are slim to none. And so you can go month after month, even year after year. Occasionally, he said, and he showed some data, you might lose 1% or 2% at the end of the year. Most years, you earned a few percent. It's a great way, he said, to earn a little extra income on your portfolio. You don't have to sell any shares, and it might help with volatility. That was his view. Now, I actually raised my hand at this point, and I said, so are you telling us that under no set of circumstances will that margin ever get called, that margin loan ever get called, and we'll never have to sell shares of this margined account so that we can buy these index, this S&P 500 index fund if the option happens to get exercised? And immediately, oh, no, I can't say that. And here's the reality. You could pursue that strategy month after month, maybe even for years, and you'd pick up nickels and dimes, and maybe it wouldn't be so bad until there was a significant market event, and then you could literally get crushed in a single month, not only losing all of the nickels and dimes that you'd earned in the months or years before that, but substantially more. Now, what was interesting about his presentation was he actually described the investor on the other side of this trade who was buying the put, right? They're the ones shelling out money for this option to force us, right, to buy shares of an S&P 500 index fund. He described that person as a gambler. That's the kind of person that likes to go to a casino. The irony is it's the exact opposite. It's the seller of that put who's really the gambler, because they're the ones risking a lot. The buyer of the put isn't risking a lot. They're risking the cost of the option, but that's their total risk. That's it. Now, why would they be doing this? Why would they be buying this buying this put? Well, it could be for them insurance. Yeah, the risk of the S&P 500 falling 10% in a month doesn't happen very often, but they want to insure their portfolio against the event that it does. Now, I'm not suggesting that kind of insurance makes sense for most investors. In fact, I don't think it does. But what they were doing was not risky in the same sense. It was in some ways maybe conservative, expensive for sure, but conservative, trying to buy insurance in case the market crashed. What he was proposing we do was incredibly risky, and I would even say reckless, something I would advise no one to engage in. And yet that was his suggestion on how to deal with volatility. So, as you can tell, overall, I was not pleased with this presentation. It wasn't educational. It was designed as a marketing event. What they were hoping to do was get our emails, and the way they wanted to do that was by offering to send us a copy of the presentation. They made a point to say, we haven't gone through the whole PowerPoint. There's no way we can, but if you just let your broker representative know that it's okay for us to send this to you, we'll send it to you via email. And of course, at that point, they could continue the discussion. Needless to say, I did not give my permission to share my email with this asset manager. So that was my experience at this free dinner investing / retirement seminar. It was really bad from start to finish. And frankly, I found it both discouraging and it angered me because I don't think what happened was unusual. I think there are a lot of great financial advisors out there that truly do have your best interest at heart, but I guarantee you they're not selling you complex, expensive investment products, and they're certainly not charging you significant assets under management. Frankly, when you get to 1%, you're paying too much in my view, even though that is the industry standard. So there you go. That's my take on it. If you've attended a free dinner seminar, I'd love to hear about it. Leave in the comments below what you came away with. Maybe there are some out there that were actually decent. I don't know. It wasn't this one. So there you go. That's my take on this free dinner investing seminar. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.